would a JEPQ retirement look like? Can you create enough income? What's going to happen to the value of those assets over time? So many good questions, and it's a good thing I've got a spreadsheet for that. Welcome to the JEPQ retirement spreadsheet. In this spreadsheet, we're going to look at all the data we have available, in other words, going back to May of 2022, to see what would it look like to invest a lump sum of money into JEPQ and retire, and then live on the income. Of course, we'll take a look at that monthly income month over month and compare that to the net asset value of those assets. We'll take a look at the value of those assets compared to the NASDAQ 100 ETF, QQQ. We absolutely will look at volatility relative to the NASDAQ 100. And I've got some extra data here to look at the end compared to a different alternative strategy for retirement. Just so you know, you can get access to this spreadsheet right here, right now, for free. All you have to do is click on the link down in the description below. Okay, so we're looking at JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. We've already done a deep dive and talked quite in depth about what this ETF is, so I'm not going to spend a lot of time on that. However, I think there's value in looking at just a few quick points. Number one, yield. Right now, they currently sport a yield of about 9.47%. But that yield is going to be relative to when you invest into the ETF, and it's going to fluctuate over time. As a reminder, it does model the NASDAQ 100. You can see that based on the number of holdings here, 106. And you can see the top 10 holdings very much mirror what you see in the NASDAQ 100. Very heavy exposure to the top assets in the NASDAQ 100, just like QQQ. Investments in NVIDIA, Microsoft, Apple, Google, Avgo, or Broadcom, etc. Now, one of the key facts here with JEPQ is they are seeking consistent premium income being income from options with, and this is key, lower volatility. And we've got an expense ratio here of 0.35%. Given the strategy, this is actually a pretty reasonable expense ratio. Okay, so we're going to operate with this kind of rough draft of a pros and cons table, and we'll come back at the end to see how much of this is legitimate. So pros and cons here. Number one, pros, strong monthly income. That's a claim, and we're going to evaluate that. And then also lower volatility than QQQ. We will evaluate that as well. Some of the cons. Number one, and this is natural whenever you're going to have any type of investment that is going to utilize options, especially on the covered call side of things, you are going to get capped upside potential. You're going to give up some of those gains potentially in exchange for income now. Not tax efficient. This is true, except for certain ETFs that utilize some of the main indexes such as RUT or NDX or SPX. You're probably not going to get that special Section 1256 tax benefit. So you can expect with this ETF in particular, JEPQ, that 100% of income is going to be taxed as ordinary income. Now, this is one that I added in here, no control over income. We're going to evaluate this and talk through it as we look at the results. If your retirement is dynamic in any way, and whose retirement is not dynamic, and your income needs change, maybe higher, maybe lower, how does that fit into holding JEPQ in retirement? This is kind of connected to the previous bullet point, but variable income. We can expect, and I think we'll see this, is income is going to change month to month, which, by the way, we didn't mention it, but JEPQ does have monthly distributions. And then, of course, we spoke about this as well, heavy tech exposure. 100 stocks or 106 positions in this ETF, but very significant weighting in the top 5 to 10 holdings. All right, so here's the spreadsheet that we've created. This is just one of the tabs. We'll dive into this even further. Essentially, we're going to start right when they launched on May the 6th, 2022. We're going to look at a lump sum investment of $250,000 and see how much income that can get us on a monthly basis. Now, one of the things I wanted to factor in here is with any type of income ETF, you rarely see the same amount of income every single month. And most people want some level of normalcy with their income. So we're going to look at two different income distribution methods. Number one is whatever income is distributed by JEPQ in any given month, that's the amount of income we're going to take out. The second distribution method is going to be more of an average. So for the first month, we'll take whatever that amount is, obviously the first month. The second month, we're going to take an average of the first 2 months. And whatever that average is, we'll take that amount out as a distribution. If that means we need to sell shares to do that, the spreadsheet is structured to do that. Then the third month, we'll look at an average of the 3 months. Fourth month, average of the 4 months, all the way through 12 months. That'll be an average of those 12 months. And then every month after that, we'll take a rolling 12-month average of the previous 12 months of distributions, so hopefully give us a little bit more consistent levels of income. Okay, so let's go ahead and take a look at the results. And by the way, since we launched in May, and based on when the distributions occur, I decided to not take a distribution in May. We just started taking them in June of 2022. And here's a look at the income. We've got in column C here, average 12-month income. Remember, we're taking that average. And then the current month income, meaning that whatever the amount that is distributed by JEPQ that month, that's the amount we take. And we'll notice here that the yields fluctuate along the way. What we notice here is we've got the average 12-month income, and then the yield associated with that income relative to how much the value is of the capital, and then the net asset value during this time frame. Same thing with the current month income, and then the current monthly yield, and that net asset value. And this data is probably gonna look better and easier to interpret on a graph, so let's look at that graph. All right, so here's that data plotted out. The columns on the bottom represents that income level, and you can see that there's clearly a difference between the rolling average and the month to month. With month to month, you can see the volatility that occurs in the income. Some months really high, like that, I don't know, 5th or 6th month right here in red, which was nearly $3,500. Versus what we saw in the average. And we see much more consistent levels of income in green, though you still see some volatility. Let's say you needed $2,500 in monthly income. Well, some of the months you get it, and some of the months you don't, even with the average. So in months when you don't get the amount of income you need, what do? Do you sell shares? I don't know. I don't have a perfect answer to this. Just wanted to point out the gaps or the flaws with this type of strategy. Now, if you need only $2,000, then most of the time you're going to meet your goal, even with the lower levels of the month to month. So you'd want to keep that in mind to make sure you retire once you have a really nice cushion or pad on this income. And you can see this, the difference here in income is pretty significant in the rolling averages versus the month to month, but the amount of portfolio balance, or I guess net asset value of the assets, is pretty similar. At times the rolling average, actually most of the time the rolling average is ahead, though at times the month to month is actually higher. Now this graph I find pretty interesting. It's the same income levels on the bottom, but the green and the red dotted lines represent the yield. And you can see how much of volatility occurs with the yield when you're going month to month. Some month you get a ton of income, some month far less. You see a lot less volatility in the average of the rolling 12 months of dividends. Now this is really good income when you factor in the yield. So I think that JEPQ really delivers on that front when you're living on the retirement income. But what about volatility? Do we actually see lower levels of volatility? Now obviously as we look at this graph here, light blue being the NASDAQ 100 ETF QQQ and pink being JEPQ ETF. Obviously JEPQ underperforms because you've got those caps in performance. This, by the way, is with all of the distributions being reinvested with JEPQ, and actually doesn't include the distributions on QQQs, but it's not a really big impact regardless. But clearly, we see quite a bit of volatility with QQQs. Let's look at this purely on volatility. When we look at this graph here, consistently in light pink, which is JEPQ, we see lower levels of volatility. The highs are lower, and the lows are not as bad. It's not a significant difference, but you can clearly see the light blue having higher pops on the upside and the downside. So when we come back over to our JEPQ retirement pros and cons, I think the pros deliver. Strong monthly income for sure, especially relative to maybe like a 4% rule. We're consistently getting yields of 8, 9, 10% or more. And you definitely get lower levels of volatility than QQQ. But on the flip side, you do get capped upside potential. I think we can all agree that's acceptable given the amount of income that's being generated. These distributions are in fact not tax efficient, almost always treated as ordinary income. Now if this is happening in a Roth IRA, an IRA, or a 401k or something similar, it's not going to matter because all of those distributions are going to be taxed as ordinary income or just be tax-free if it's a Roth IRA. I think the biggest factor here is the last three items, and some of which we don't even really know the true downside potential. You just don't have control over income. JEPQ runs their strategy the way they want to run it, and while it's worked out pretty well over the past 3.5 years, they're not going to change it based on what you want to do. It'll be consistent. And because retirement is dynamic and your income needs may change, I mean, what if you've got a significant income need that pops up in the fall to where you need an extra $2,000? Maybe you've got an emergency fund of cash, but let's say you're focusing on getting income from this account. What do you do with JEPQ? You're only going to get delivered maybe $2,500 or $3,000 based on whatever amount you've invested. What if you need $4,000? Do you sell shares in order to create that extra income? And at that point, are you killing the golden goose who's laying the golden eggs? Is the goose golden? The goose that lays the golden eggs. Point is here, you're reducing your income viability or future prospects of income because of the fact that you're selling shares right now. So that puts you kind of in a little bit of a bind, and it makes it harder to have a dynamic retirement from an income generation standpoint. Like I said, variable income and of course heavy tech exposure. This fund, just like QQQ, is heavily weighted on the performance of the top 5 to 10 stocks, which has worked out great over the past 5 to 10 years because Nvidia, Microsoft, Apple, Google, Broadcom, Amazon, Meta, Tesla. These are all stocks that have done really, really well. Costco as well. But what if we have a downturn? What if Nvidia is no longer as competitive as they have been and they don't outperform as much? I don't know the future. From that perspective, there's quite a bit of concentration risk here. Now, here's a quick alternative to consider. We've talked a lot in the past couple of weeks about backtesting option strategies and taking more of a DIY approach. Not to where you're looking at the stocks every day and you're trying to do things every single day, but a very simple and straightforward strategy where you hold cash, collect that interest, but also sell very consistent and boring weekly options on QQQ, for example, though you could choose other stocks or ETFs. A, can it deliver that much income? B, does the tax treatment change? And C, what does the volatility look like relative to JEPQ? Now here's a look at that part of the spreadsheet. This is included in this spreadsheet, again, which you can get for free. Just click on the link down in the description below. And we looked at the same time frame and the same amount of money. Now, obviously, there's quite a bit of different ways you can set this up. You could work with the 5, 10, 15, 20, 25, and 30 delta. Now, based on our results in the past, we're going to look at a 20 delta, which is a good medium between income generation and reduced risk. And of course, we have to figure out then, well, how much are we going to take as a distribution every month? So I tried to model it very close to what we get with JEPQ, though it could definitely fluctuate and you can change it, right? So there's dynamic elements to this spreadsheet. But we're just going to assume that every single month we're going to take out 0.85% of the portfolio balance rather than focus on just the amount of income that's being generated by the portfolio. Now, all this data is back tested with tons and tons of hours of work and time and screenshots. And that's all available in a different spreadsheet, just FYI, but all of this is back tested to 2020, though we're only going back to May of 2022. Here's what that income looks like. And one of the things you can catch right off the bat, just so you know, we're gonna look at the graph, including JEPQ, but just for now, one thing that you should notice here is that this income is really, really consistent. Very much within a tight window of between, I don't know, $2,100 and $2,300, very consistent. And this you have quite a bit of control over. And if you have dynamic changes to retirement or your life, what's happening in your life, you can adjust this income as well. So here's all this data on one graph. This is just the income. We're going to look at the net asset value here separately. So the red and the green lines are just as what they were before. JEPQ, the two different distribution types, looking at an average, which is in green, and in red, we're going to look at the current month or month-to-month income, which obviously has more volatility in it. You can see right off the bat that clearly light blue, which is holding cash and selling put options on a weekly basis, has the most consistent strategy. And you could adjust this, of course. If you wanted only $2,000, all you got to do is take out $2,000. If you need $4,500 for a given month, you can do that, and it doesn't dramatically change future income generation, whereas it definitely would with JEPQ because you then would have fewer shares. So from an income standpoint, it's a little bit lower obviously than the red line and at times the green line as well. And of course you could structure this to grow by the rate of inflation in the future. Now let's look at the net asset value. And I want to give you just a second here, take a look at this graph and come up with your own conclusion. Now your first thought here might be, Joe, one of these is clearly better than the other. And to that I would say yes, in the end. But there were plenty of times here where one of these investments would have been far more favorable than the other. And to figure out what's best for you, you have to put your retirement hat on. What do you want in retirement? Do you want stability? Do you want maximum income? Are you okay with variable levels of income? Obviously, what's most important is going to change depending on who you are, your risk tolerance, and what you're trying to accomplish. But in looking at this graph, there's clearly far less volatility with the cash plus selling puts portion of the portfolio compared to JEPQ, although it's very clear, and I will admit openly, that JEPQ in the end, over this 3.5-year time frame, had a higher net asset value balance, though that wasn't true at all times. In fact, for nearly half the time, we were at or above the level of JEPQ. One other metric I think is relevant to talk about is the Sharpe ratio. Not just what is the historical performance, those total returns, but also what is the risk-adjusted return, factoring in volatility. It's known as the Sharpe ratio. The Sharpe ratio tells us, given the amount of changes in the portfolio and that overall performance, which investment is better. And so we captured that for you. Here's a look at JEPQ. If we scroll all the way down to the bottom here, in this spreadsheet or tab of the spreadsheet, we scroll all the way to the bottom here, we've got our standard deviation, average excess returns, and we've got And this is relative to the risk-free rate, by the way. The monthly Sharpe ratio is 0.22, the annualized Sharpe ratio 0.77 for JEPQ. Now, 0.77 is not a bad Sharpe ratio, but how does it compare to holding cash and selling QQQ puts? We already saw lower levels of volatility, but how does that translate into a Sharpe ratio? Sharpe ratio here is far higher. Biggest thing I want to call out here is the standard deviation is 1.019 here for this strategy, whereas JEPQ has a standard deviation 4 times higher, which is primarily contributing to this difference in the Sharpe ratio, which means that given the amount of risk involved, this strategy here is far better. Guys, I'm not telling you what to do. I'm not telling you which strategy is best for you. I'm just trying to present the JEPQ retirement plan as best I can, considering we only have 3.5 years. We don't know what the future holds. JEPQ could continue to blow it away in the future, and it might be a really great fit for you. Or maybe it's just a part of a larger high-yield income portfolio. However, I'm of an opinion that when you're in retirement, stability matters. Lower levels of volatility matter. Consistent income matters, especially if you need control over that income. The ability to say, well, this month I need this much, and in the future, hey, I want to buy an RV, let's say, for example, or I want to buy a car, I want to go on a special vacation. How does that factor into a JEPQ retirement versus doing it with a cash plus selling puts? One strategy does a better job, in my opinion, of managing the dynamics of retirement than the other. Hopefully you found some value out of this video, guys. As a reminder, you get access to the spreadsheet for free. All you got to do is click on the link down in the description below. Also, make sure to leave your 2 cents down in the comments below. I love feedback. I love controversy. I love conflict. No, actually, that's not true. But I do want your opinion. I want your feedback. Was there value in this video? What did I miss that I should have talked about more? What other high yield ETFs do you think deserve this type of comparison? Please leave it all down in the description below. That's all I got for you guys. Have a great rest of your day, and thanks for watching.